Well, there's obviously NVIDIA, which has become a go-to name when it comes to playing AI, but there's also this company called C3.ai, which has rocketed higher in 2023. We just got the company's earnings, and on the back of that, the stock is falling, even as revenue beat estimates, but it only grew 0.1% in the most recent quarter. The enterprise AI company says sales in 2024 are going to be lower than what analysts were hoping for, and that is the reason we are seeing a pullback in the stock. Obviously not enough to satisfy investors. The view on this is very polarized. The most optimistic target comes from Dan Ives, which just upgraded the stock $50. That's a street high target. But the low is $14. So a very wide range and a heavily shorted stock as well, considering it's up more than 200% so far in 2023. That's a painful trade. 27% of the shares outstanding are short. Our next guest has been bearish on C3.ai. Let's bring in Ivana Delevska, the founder and CIO of Spear Invest. Ivana, thanks so much for being with us. For those that aren't familiar with C3.ai, other than its ticker is literally AI, it's not a new company. It's been around for a long time, and it makes artificial intelligence applications and softwares for businesses to deploy. So it's sort of an enterprise solution. And it's in the midst of this transformation, they call it, to better deploy generative AI and change the way they charge for things. Does that kind of sum it up, Ivana? And I know you've been tracking it for a long time.
That's right, Amber. So thanks for having me. We have an ETF that invests in AI, and C3 is not part of our holdings. So we often get this question of why is that the case? We disclose our holdings on our website, and basically it all goes back to fundamentals. We believe in the next 5 years, there is going to be no rising tide lifting all boats, given where rates are. So you're really going to have to prove out your investment thesis by providing upside to the earnings estimates, right? So, and C3.ai is basically been around, as you mentioned, for a while. The company is projecting to grow only 15% versus the industry growing at 40%. And in the meantime, it's losing on a GAAP basis almost its entire revenue. So analysts are estimating that they will lose $300 million on a GAAP basis next year, and they're going to make about a little over $300 million in revenue. So while losing money is not necessarily on a GAAP basis always negative for stocks, it is when the stocks are only growing at 15%. So for this type of money losses, you would expect the company to grow at 40, 50, 60%.
So one analyst, as I mentioned, Dan Ives, that is looking through that tepid forecast is just chalking it up to conservative guidance as they switch their business model. They were doing largely subscription-based charging, and now they want to do consumption-based charging. So they just chalk it up to that. You know, they're in transition. They're going to capture this. They've got these killer apps that are in the works, and they just don't want to raise the bar too much.
Well, the guide could be conservative, and they could be getting interest from clients, given that AI is now in the main focus point for companies as well as investors. But on the flip side, their products are not proven, right? So they're not proven to make money. They're not proven to work. So we really believe it's going to be all about if you're showing results, right? So if we do see results tick up, right? If we do see them turning profits over the next 2 to 3 years, we have nothing against the company, right? But at this point in time, they've been around for a while. They should be showing some better results.
And it's interesting that it does come down to the products. Is that the crux of your thesis, that you don't think they have a compelling enough offering compared to what else is out there? I know in their I think it was in March when they kind of had sort of a product day and showed what they're capable of. It seemed impressive, you know, real work that they're doing with pilots to help them, use AI to better do their jobs and complement some of those functions. Why isn't that enough to convince you?
So Amber, it's very interesting that AI companies of yesterday may actually be the losers tomorrow. And this is because they're all based on technologies that were previously used rather than generative AI. So while the company may be talking up generative AI and implementing ChatGPT in their products, I don't quite see how ChatGPT is going to be helpful for a customer like Baker Hughes. So I think we're still in that stage of proving that their products work, that they're next generation, and that they can make money.
So I guess what I saw as a description for how can something like ChatGPT, essentially generative AI, be used for these companies is that now you don't have to be an engineer, a machine learning engineer, to access AI, right? It becomes a little bit more user-friendly, that your more everyday employees that don't necessarily have engineering background can put it to work.
Well, that's right. That is basically the thesis around AI and generative AI in general. Whether you're a software engineer, mechanical engineer, you're going to have these digital twin models that can help you optimize operations, optimize processes, do predictive maintenance. However, I would caution that this is a big problem and the solution is going to be pretty big. It's not something that one company that had a product yesterday will be able to provide tomorrow. So we think somebody like NVIDIA, for example, is a lot better positioned there because they have the hardware, they're providing the compute power, and they're providing a platform called Omniverse that you can use basically if you're a company to build a digital twin, and you can integrate all your other software providers like Adobe, Blender, that people use in these industries to solve problems. So the problem is not as, the thesis makes sense, it sounds good, but it's not as easily solvable with a plug and play solution that we believe C3.ai offers today.
It's one thing not to include it in your AI ETF, but another to short it. Would you short it?
Well, that's a great question, Amber. I would not short it, and the reason is because as there is interest in AI, people are piling into passive funds, and those passive funds are investing just based on ticker name or description basis. So they're really not going to be investing based on fundamentals. You're going to see flow towards these names until a catalyst happens and people start focusing on fundamentals. So it's really hard to, we always think about risk reward when we invest, right? So it's all about capping the downside and finding good upside. And here it's very difficult. If you're a short investor, it's very difficult to cap that downside on the short side just because of the flows.